Hello friends and welcome to this video. So friends, in the previous video we discussed how we can find fundamentally good companies or companies which are falling into my investment style, in my investment criteria using screener tool, right? Now once we have selected company to invest into, the second step is finding the fair value of those companies to decide whether the current market price is the right price or not to enter into those companies. Now in this video we'll discuss briefly basic components of DCF, right? And then we'll move to the template part and the calculation part. So this will cover in the next video. I'll discuss basic concepts of DCF here. In case you want to develop your detailed understanding about DCF, so I've created a very detailed video on DCF, which you can refer. It's available on the YouTube. And guys, I'll provide link of this video in the description also. Now, discounted cash flow, DCF. So DCF is what? Under this method of valuation, we discount future cash flows to present value. It's simple process, discounting of future cash flows to the present value. Now, what cash flows we are talking about, what discount rate we are going to use, right? We'll discuss about these two concepts briefly here. First, let's talk about free cash flows or cash flows. So guys, we don't discount normal cash flows in DCF. We discount free cash flows in DCF. So free cash flows means free for distribution, the cash flows which you can freely distribute to your stakeholders, right? So we look at this cash flows from two perspectives. One is free cash flows to the firm and other is free cash flows to the equity. Okay, so if you're interested in finding DCF value of the entire business, okay, irrespective of debt and equity, then we calculate DCF free cash flows to the firm. But if you're interested in finding DCF value of just equity part, then we'll calculate DCF value free cash flows to the equity only. Okay, generally guys, we focus on free cash flows to the firm in DCF technique. Reason being, by discounting your all the future cash flows which are not affected by the capital structure of the companies, means how much capital company has borrowed from debt and equity, if you don't want to create that impact into your free cash flows, FCFF, free cash flows to the firm, will give you better picture of company's earnings. Okay, because it is not impacted by the difference in the capital structure of one company to other company. Two, from this DCF value of the firm, we can easily reach to the DCF value of the equity at the end. Okay, so you will see most of the time analysts are focusing on free cash flows to the firm, not to the equity. Okay, because sometimes this equity, free cash flows to the equity, is impacted by difference in the capital structure of the companies. Okay, now what is free cash flow here? What is free here, right? We understand cash flows, what business is earning from its day-to-day operations, but what is the meaning of free? So let's understand this quickly. So guys, here, as we are interested in free cash flows to the firm, I'll start with my first number here, EBIT, which is earning before interest and taxes. This earning is called firm earning, right? Reason being guys, why it is called firm earnings? Because we have not paid any interest from this earnings, right? So this earning belongs to both debt and equity. It is not impacted by capital structure of the company, right? So say EBIT of the company is 10,000 crores. I'm just assuming some numbers here to make you understand. Now guys, this is earning before interest, that's fine because we need firm level earnings, but at the same time it is before tax also. But you are supposed to pay tax to the government, right? So we'll first pay tax on this earning, and let's say tax rate is 25%. Okay, and if I pay tax on this earning, it will be almost 2,500 crores of tax on 10,000 crores of earnings. So I am left with 7,500 crores earnings to the firm after tax. This is called NOPAT. This earning is called NOPAT, net operating profit of the business after taxes. Now, can I distribute this 7,500 crores to my equity and debt holders? The answer is no, Because out of this 7,500 crores, what you have earned, your business has earned in a particular year, say I'm calculating this free cash flows for year 1. Okay. So of this 7,500 crores, I need to retain something into my business, right? This is not a free cash flow, because if I distribute this entire earning to my stakeholders, my business will not be able to grow, right? So what I'll do, I'll make 3 adjustments here. Adjustment number 1, first of all, I add back depreciation and amortization expenses. Now, why I'm adding back depreciation amortization expenses? Guys, when I calculated EBIT, operating profit of the business, earning before interest and taxes, this D&A expenses was deducted because it's a business expense, right? So this D&A expenses was deducted here. And because this expense is creating no impact, negative impact on cash flows, it's a non-cash expense. D&A is what? Amortization of expenses, what you incurred in the past, right? So D&A is a non-cash expense, and because I'm calculating free cash flows available for distribution, I'm adding it back. It's a non-cash expense. So it was deducted before when I calculated my EBIT, which is the basis of my NOPAT. I'm adding it back, and let's say it was 1,000 crores. So I first deducted 1,000 crores here. I added it back to nullify the impact. Now, can I distribute this 8,500 crores? Because 7,500 crores was NOPAT and 1,000 crores is my D&A. The answer is no. Reason being, from this 8,500 cash profit, I first need to invest into my capital expenditures, which is called capex, right? Because I need to grow my business, right? I just showed you, in the previous video, in the screener tab, companies which are into expansion mode, companies which are investing more and more into their fixed assets and the growth assets. So I want to subtract that part of the earnings which is required for my expansion, for my growth. And let's say I need 3,000 crores of capital expenditure next year. So that I deducted. Now guys, at the same time, when your business will grow, at the same time, you also need to invest into working capital. Working capital. Okay. So maybe your last year working capital was 5,000 crores and this year working capital would be 6,000 crores. So what additional working capital you are required? So this is your year 0 working capital and this is year 1 working capital, right? So you will see when the business will grow, they would need more inventories, more debtors, right? More, I'll say other assets, more advances. At the same time, you would have some cushion coming from the current liability side, creditors and all, but net, your working capital, which is current assets minus current liability, last year you had a total investment of 5,000 crores and this year it is 6,000 crores. So what is change in the working capital? It is additional 1,000 crores which has been invested in the working capital. And guys, after making these 2 adjustments, 7,500 was my NOPAT, earnings to the firm, plus 1,000 minus 300 minus 3,000 minus 1,000, which is my working capital change. I am left with free cash flows, which is what? 8,500 minus 3 minus 1, 4,500 crores. That's my free cash flows to the firm. So guys, this is what concept of free cash flows means. Cash flows available for distribution means this cash flow is free. I've deducted whatever required in the business, whatever required for the growth of the business, and what surplus business is able to earn in the future. This I need to estimate. I need to do this estimation, guys, because DCF is what? Discounting of future cash flows. You're supposed to discount future cash flows, right? Because you are finding this value today based on how much cash flows business will earn in the future. So guys, this is first and most important part of any DCF, okay? And you have to do these projections. You need to do these projections for all the years till the time your business will survive. And guys, say you are expecting this business will earn, say, 4,500 crores next year, right? And say in year 2, there is a growth in the business. I'm just taking some random numbers, guys, to make you understand. In the next video, we'll do this calculation for the real companies. So next year, I'm assuming 5,000 crores. Year 3, I'm assuming 5,000 800 crores, right? Year 4, let's say 6,700 crores, and so on and so forth. Now, the question is, till when I'll do these projections? When this projection will come to end? The answer is never. Because you normally assume that the business is what? Business is going concern. And if it is a going concern, this projection should be on forever. You have to do this projection for infinite period. But guys, don't worry. Here we have a solution, because we cannot keep on doing this projection forever. So the solution is what? We have a concept called terminal value, the TV. Full form is what? Terminal value. So what this terminal value is, again guys, you can refer my detailed DCF series of the videos if you want to understand these concepts in detail. But just to give you a brief about terminal value captures value of the cash flows for all the period up to infinity. Captures value of cash flows up to infinity, but starting from which phase? When the growth is constant. So guys, in this projection, in this series of the projection, the moment your growth reaches to a constant phase, means when the company is out of the high growth phase, and then it will enter into a constant growth phase when the growth fluctuation is very limited. This is called a constant growth phase of the business. From this phase to infinity, no projection is required. This part of the projection will be taken care of by Gordon's growth model. What this model is, this Gordon's growth model will give you a value of all the future cash flows up to infinity. The only condition is it should be applied at the end of that phase where the growth is going to be constant. Okay, so let's assume my business, which is expected to grow at a high growth rate in next 5 years, 10 years, whatever, and after that my business will reach to a constant growth rate of 5%. Okay, now what would be that constant growth rate? Normally we assume GDP growth rate of the country would be equivalent to my constant growth phase, constant growth rate, because we assume that in the long term, when the business gets mature, their growth will settle down around the GDP growth rate. Okay, so if I'm assuming my business will grow mature, in next 10 years, after 10 years, I need to do projection for 10 years. That's it. And I need to stop. After 10 years, the value of the cash flows from year 11 to infinity will be captured by this small formula, which is what? Cash flows of immediate next year. Next year means if you're stopping your projection at year 10, this would be cash flows of year 11. Okay, so immediate next year cash flow means the cash flows of the year immediately next. So cash flows of the immediate next year when you're stopping your projection. If you're stopping your projection in 5th year, that would be 6th year cash flows. If you're stopping your projection in 10th year, this would be 11th year cash flow. If you're stopping your projection in 15th year, that would be 16th year cash flow. Always remember, this is the cash flows of next year divided by R minus G. Now, what is this R? R is nothing but discount rate, which I'll discuss briefly in the next part, in this video itself. What is this discount rate in the next step? And G is what? Your constant growth rate. Constant growth rate, which is 5%. Okay, so this small equation, which is what? CF1 upon R minus G, will give you value of all the future years cash flows starting from, in this case, year 11 to infinity. Okay, and this terminal value, because this is at the end of year 10, right? Because you're calculating this at the end of year 10, need to be discounted back. You need to discount this terminal value to year 0. So you need to apply 10-year discounting here. Okay, so what would be discount rate? We'll discuss now. Now guys, in all the future cash flows and terminal value, we need discount rate. Now guys, to discount all the future cash flows and the terminal value, we need discount rate. Now let's discuss discount rate. So as we are discussing, we are discounting free cash flows to the entire firm. So the discount rate should also be for entire firm, which is what? Firm means what? Debt and equity both, right? It is not discriminating between debt and equity, right? It is assuming both are source of capital. Now discount rate means the cost of funds. So this would be cost of equity and cost of debt. So cost of debt, which is the simplest one, is nothing but your interest rate. The interest rate what you are paying on the debt, right? That's your cost of debt, right? And because this interest rate is tax deductible expense, because when you pay interest, government gives you tax deduction of this, right? So you will save some tax. So I'll deduct this tax shield from this interest rate, 1 minus tax. Now this is called net of tax. This is called net of tax cost of debt, KD, right? Cost of equity, guys, is slightly different. Okay, it's bit complex than cost of debt because it is not explicit. Because in case of debt, it is explicit. When bank gives you loan, they charge you interest rate which is mentioned, right, in the loan agreement or document. But in case of equity, when company raise equity from the investors, nothing is mentioned, right? Nothing is explicit here. So how we calculate this cost of equity? This cost of equity is nothing but expected return by your shareholders. What return your shareholders are expecting from the company. So here we need to gauge this cost of equity. What we need to gauge this expectation, because it is not explicitly given. And to understand what your shareholders are expecting from your business, your company, when they're putting their money into your company, we use a CAPM model. Full form of CAPM is capital asset pricing model. So this is what? Capital assets pricing model. Okay. So what this model says, guys, this model is pretty simple. It says, okay, to gauge the expectation of shareholders, you should start with the risk-free rate. The return what any investor can earn without taking any risk, risk-free, 100% risk-free, right? Which we normally assume as a 10-year government bond return, government bond yield or return. Okay. So whatever you can earn on 10-year government bond yield, right? It's a long term also and it's safe also, right? Because there are very least chances of government default, right? So it's a 100% risk free. Now, because you're putting your money into stock market, not into government bond, right? So you're expecting some premium, right? So this CAPM model is calculating what? Cost of equity, right? Not cost of government bond. So it says you should start with the government bond yield, which is, say, in India right now, around 6.5%. So I'm taking 6.5. Later on, we can refer what exact return is. Now, because you're taking risk when you're putting your money into stock of the company, so risk is what? Risk of the equity market. So this is called equity risk premium, right? Equity risk premium is what? The premium what equity market has earned for the investors or expected to earn for the investors, right? When they put their money into equity market. So, for example, guys, if you look at the historical data of the Indian stock market, we can see Indian stock market has earned 14% return on year-on-year basis for last 15 years. Okay, there is a 14% CAGR. Okay, consistent return. So I'm not talking about yearly ups and down, but if you would have invested 14 years back, consistently you got 14% return if you would not have exited in between, right? 14% yearly return. And if I say, okay, out of this 14%, 6.5 I could earn without taking risk because that's a risk free. So what additional premium market has earned for you? The additional premium is coming 7.5%. This additional premium is called, equity risk premium. Okay. Now, risk-free rate is pretty simple. Risk-free rate is what? What you can earn without taking risk, which is 6.5 now. Now, guys, can I calculate my cost of equity by adding both the factors? The answer is no. Because this premium you are getting for risk in the equity market. But the individual stock risk, because you are calculating cost of equity of individual company. So that individual company's risk can be different from the market risk. So we multiply this equity risk premium with beta of the stock. beta of stock. So this beta of the stock is what, guys? It measures. What this beta do, guys? This beta measures. It measures risk of the company versus market. Market is what? Your equity market. So how risky your company is compared to the overall market, say Nifty, and accordingly your premium will be adjusted. Suppose your stock is a high beta stock and your beta is 2. It means your risk is 2 times the market. Then you should get 2 times the premium also. So if market is giving you 7.5% premium, so your stock should return you what? 2 times of this extra premium. It is 15% plus 6.5% was the base rate, risk-free rate, and the cost of equity will be what? 21.5%. But in case this beta is less, suppose your stock, you are investing into very safe stocks, say FMCG companies, so this beta could be even less, say 0.5. So risk-free rate would remain same, plus beta will become what? 0.5 now. Market equity risk premium was 7.5, but the stock premium would be less because the stock has less risk compared to the market. So your cost of equity would be what? 0.5 into 7.5 would be what? 3.75, okay, plus 6.5% was the risk-free rate. So it will be 10.25%. So you can see, guys, with the change of the risk of the company, expected return of the shareholders will also change. So guys, in the DCF classes videos, we're going to apply these concepts. We're going to apply all these concepts on the real companies. We'll see, okay, first, how we can, calculate these numbers, these assumptions, and then we'll apply these assumptions on the companies which we want to value. Okay, so in the next video, I'll discuss, I'll use a standard template, which I'll share also in my video, and we'll see how we can run this valuation. See you there. Thank you.